Turnaround Tuesday, Warriors. How's everyone doing? Hello, Mary. How you doing, Ryan? Ran, I'm only a figurehead. And Sinatra, how's it going? So, team, it's nice to have my internet back. Your whole world stops when your internet is off. So, good to be back. How's everyone doing today?
Good to see you, mate.
Yeah.
Good to have you back, Dale.
Yeah, thank you, guys. So, why don't I start with Ryan? Oh, before I do, I just want to, just a thought I had. Last week I thought it was pretty strange when we had that national emergency broadcast test that Israel was included in it. No other country outside of the US was involved in it. Not Canada to the north or Mexico to the south. And then this happens Saturday, 60 years after the Yom Kippur War, but probably doesn't mean anything, just a coincidence that we had that test. And Israel participated.
What do you mean that Israel was part of that? That I didn't know that.
Yeah, they were. The Israelis were, a lot of them didn't want to participate, but they were part of it. That national emergency test, which was strange. I mean, why?
Well, that is strange.
Anyway, so I thought I'd just bring it up. Anyway, and there were things like, I actually talked about that comet we had about a month ago. The ancients, which, they had some pretty insightful knowledge. They always thought it was a harbinger of war or famine. So anyway, it's a tragedy what's going on. Amazing how the markets have held up. First with the NFP on Friday, how they roared back, and then after starting off lower Sunday evening coming back. So pretty impressive. Why don't I start with Ryan? And US dollar yen can't really maintain any close under 48.50. No. Do you think we have a shot for another high above 150, above this high?
It's possible. The dips are getting bought, but the rallies are also getting sold. So we've got a game going on here, one that I'm not quite inclined to get involved with. 150 is obviously the marker up top. That's one everyone's going to have eyes on. If we get there, can it break? Will we see more selling up there? And what happens if it does break? Do we break forcefully and take another leg up, or will it be tentative on fears of someone coming in and hitting it with a hammer? We can't get below that 148.50, but we do make a lower low. We did make a lower low overnight, and that tells me that the pressure's still on. That it's more a rally sell than a dip buy, but it's marginal.
Okay. So it's kind of a range trade, and bond market was closed yesterday, and yields came off quite a bit. I don't know if it was flight to quality because of the war, but double top pullback. So I don't know. My bias is that both yields and the yen make another run at the highs. Okay, call me kooky, into the eclipse this weekend. So we'll see what we'll see what happens. Anyway, and also well played, the team, and Ryan and Blake after the NFP. This was the NFP, and Blake was buying weakness in euro that day. Even the euro has really shrugged off these events. You think we have enough juice to get to 107? Because there really was no big bid in the dollar yesterday either. So are we headed towards 105, 104.50? Something.
I think today's rejection was really, really a big deal to the dollar index, where the euro stopped. And I'm sure, Kman and Ryan have probably talked all about that during the flow show, but really big levels were tested overnight. And I think that's got to be respected, right, guys?
Okay. Yeah.
Yeah.
Okay. So
Yeah.
4.5 to 6, if we start taking out this major resistance, Blake, 4.5 to 6 gives you what, 7.5?
Yeah, I
108?
mean, I think the number that we've had on the bias chart and as resistance is 106.20. We get above 106.20 and we should go a lot higher in the euro, but that it's hard to do. It's hard to be really super bearish the dollar with things getting a little heated up in the Middle East. I for me I have a very difficult time doing that. So
okay. So
maybe I know the market could crawl up the wall of worry, right? But but still, I don't know.
Well, I saw that interview. You did a nice job with Don Dawson. He's a sage.
He's a nice guy. He's a nice guy. Where'd you find him?
Referred to me by someone who I don't interview anymore. I can't remember.
Oh, okay. Well, I was like, how do you even find somebody like that that's not even on social media anymore?
Yeah, from someone else. I do get recommendations on Twitter from followers and people of some people that I should consider interviewing, this guy or this gal. And, I appreciate it. So if you guys have, favorites, there's sure, there's a multitude out there, but if you have favorites, let me know. I'm not afraid to, extend an invitation and then hear a no or hear nothing. I don't cry when that happens. So if there's anyone you want to hear, I'll give it a shot and invite them into F.A.C.E.
You know what? That's a true testament of, Dale, and this goes back to early days. As a stockbroker back in the 1990s, I would have to dial at least $300 a day, and I know you in the 80s and earlier probably have done the same thing.
Yeah.
Tell me no all day long. I don't care.
Yeah, it just means you're closer to a yes.
Right.
That's what we were taught, and
right.
We believed it, and it was right. Anyway, Kman, how are you, buddy?
Hey Dale, hi, hey everybody. No, I'm good, man. I'm good.
What are you thinking about yen and yields here after two major events, the NFP and then the outbreak of war?
And something strange happened because dollar yen did not. Well, it went low yesterday, which was logic with the yields being lower, but then we came in this morning and the yields were even lower, and dollar yen was actually back up. Suzuki said that the reason for the yen weakness is the differential in interest rates. Okay, well, I mean, you don't have to be an economist to know that. We've been talking about it for years. It has been taken as a step back from interventionist rhetoric. And I reckon that's why, together with the stock markets being higher, that the yen got a little knock on the head, especially through the process. What I think about the yen is, I think we still have to watch those US 10s for the dollar yen, because we're coming on to, and I showed it over the flow show and in the room as well a couple of times, we're coming on to trendline support in the US 10s in the yields, somewhere between 460 and 65. And then you will see your 450 is the last springboard up to the recent highs. So we've got PPI tomorrow, we've got CPI the day after, and we've got another week of especially 3-year, 10-year, 30-year US Treasury bond issuances. And I reckon that's going to decide upon your US yields. And so since everybody is looking the most at the 10s, I reckon that it's might be decision time this week, because if you start to get lower, then probably your dollar is finally going to suffer a little bit. I don't see too much of a reason why, but the Fed speakers yesterday have said that those higher yields are doing a part of their job, so they don't see the need for higher US rates right now by the Fed. So it's all going on, but I still think that we are more in a range than really picking a side.
Right.
For me, it would be sufficient for the dollar yields to hold this 60, 65 and stabilize above that level, for the dollar to just continue to remain attractive for the medium term. But I won't say that it can't correct. And as already widely known, the 106.20, I'd stretch it even to 106.40, 45 in the euro dollar is relatively important. We went up above 106 today, failed again. Aussie same. We went up to resistance, failing. Cable roughly the same. I'd say 123 figure 20 on the cable is going to be very important. And for the time being, I see why the dollar is correcting, but I don't have reasons yet to believe that we are really starting to turn around completely.
Okay, I just want to point out, first time this has happened in quite some time. You have a 4-hour divergence in TLT, except, you know, it's not ideal. It's under 30, just shows you all the downside momentum, but it is diverging. Next time down for 3, it should hold above 30. Don't be short TLT is the main message. You know, it's doing the same on the daily. So, you know, I don't think it's time. This is a time. I know a lot of people, including Grega, what this last decline in the 10-year, this, I know it's TLT, was 5, right? So 5 means eventually you get completion, and looks like, you know, we might be getting close because we're starting to get some divergence here on TLT. Just wanted to mention that. I may take a shot. They have a triple ETF on TLT. It's TMF. It's the same, you know, basically the same thing, and you're getting this little.
I mean, you got to wonder, Dale. If I mean, I know there's all, you know, everybody's been talking supply, but at what point did they offer really, you know, some value down here?
Yeah.
So I mean, I don't know. It's
yeah, it's definitely not to me, not a short anymore. I don't know. Be good to have Greg on, see if he thinks that it completed.
Well, he's here, but before we bring him on, and Greg, good morning. How are you?
Hey, good morning.
The last thing I want to say before I turn it over to all you guys is Friday. I talked about that if the dollar relented and yields relented, we could rally to 43.40 or so in the S&Ps. I didn't play the rally, okay? But that's what happened. And as you can see, I have fibs drawn off this wave. So that should give you a hint what my bias is and what I'm looking to do.
Well, shit, Dale, it was the squiggly line that gave it away. I don't know what anybody else is looking at.
Oh, yeah.
But that damn squiggly line.
Yeah, the spaghetti indicator.
I mean, that gave it away. Great call.
So 4,200 was, you know, I mean, so textbook.
It was.
Do you think it's going to hold though? Do you
What's
think
that?
it's going to hold? Do you think it's going to hold that textbook? You know, now people have had, I don't know what, 1, 2, 3, 4, 5 days to get long against 4,200. I think they have to clean it out. So, you know, that's my vibe, is that it's too textbook.
I would agree with that. I don't think it will hold. I think it's going to eventually break. It's kind of like I use the analogy of like the battering ram and the castle door, you know, the castle, castle gate, you know, it's going to take a couple of good old tries. But I'll tell you one thing that probably keeps it in line is going to be, or in view rather, you know, when you get the S&P back down here, or if it gets back down here, is going to be the dollar index. And the dollar index is, I have to mention it's held major support. I mean, it even probed the lows today below the 105.88, which was the previous high right here. We got below it. We're on channel support and we reversed. So I would say that if the dollar hits new highs today, you don't want to be short the dollar. And one of the things that is obviously supporting it right now is the move higher that you see in yields. So, this move higher in yields, I think, needs to be respected. I mean, everybody thinks that, oh, well, the dollar, it's over. And, Dale, I know you just said it yourself, hey, maybe thinking about buying some bonds here. And I think a lot of people are probably thinking that as well. But let's not forget that that we're still in kind of an accelerated state in the bond market and yields for that matter. I mean, you look at the 30-year, it's not really backing off. This looks like, to me, and I'll just say technically, this looks like some sort of bullish, pennant consolidation before we make another move higher. I'm going to have to see a little bit decisive move lower in yields to really say, that it's done here. I mean, that's just a personal opinion. I don't think I'd want to stand in front of it. But and just some thoughts, and also one of the other things, and then I want to hear what the team has to say here, and then bring Grega in. Is you look at the dollar, you look at where the dollar stopped. Again, let me grab the dollar really quick. Where is it? Okay, look at the dollar, look where it stopped, right where it should, right? Then you look at gold, and you go, gold rallied. And it stopped right where it should too, 1860. We wrote this down yesterday on our bias chart. The 1860 level would be key resistance, and that was at we put an asterisk there, which denotes that it's such important resistance. And that was yesterday, down here. This is 24 hours ago, so we were trading at 1830, and we made it up there. Just kind of probed right into it, and this is a previous major trend line that was broken. So, watch gold. I think gold's a pretty good indicator. If gold starts breaking out, I mean, that's an indicator to me that the dollar's probably going to slump, and you probably are going to see a continued move lower in yields and a rally in bonds. So it all seems to be very connected right now, and the correlations are very tight. So you have to respect the fact that correlations are so tight at the moment. And use them to your favor. That doesn't always happen this way. Correlations are not causation, but when they are all jiving like they are right now, you should be paying attention to it. I wanted to really quick ask Ryan and Kman, because you guys were up earlier than those of us in the North American, or the Americas, as Kman likes to call it, because it's not just North America, it's all the Americas and Canada and everything else. Anyway, you've been up a little bit earlier. China, there's some reports from like a Bloomberg article that says that China might actually launch another stage of stimulus. What do you guys make out of that? Because you saw the US dollar CNH was selling off in Asia, and then we saw a big reversal. So the CNH was firming up. What do you guys think about that? The news the speculation that's swirling around?
Well, it firmed up on that headline. That's that secondary candle you got there with the deep wick.
Oh, okay, that's this one right here.
Yeah, because the market it's changed. Previously China easing, doing more fiscal stimulus, was seen as weak, negative for the currency. But now that's flipped, as we've been pointing out. Excuse me, that stimulus is now seen as fixing the problems, so it's positive for the currency. But it's weird because, like you say, dollar China was moving down through that 728 level, got down to 727, held that, bounced with the dollar bounce this morning. But they're doing it to help hit their GDP target. So you've got to understand how they're going to do that. They're going to use this money, potentially higher debt, higher deficit, whatever. They're going to put that money to work. They'll get, several 100,000 people building this, that, and the other, roads, water plants, whatever. that adds to GDP. That creates activity. So they're spending to create activity, so they hit their target. So it's a bit of a false economy, if you like, because once they've done that, well, what happens after they've finished all those projects and spent all that money? Then they move on to hitting their GDP target the next time and doing the same thing. So it's not real economic activity, if you like. It's manufactured economic activity.
Yeah, it's like infrastructure spending. It's slight infrastructure spending that may take a long time to what do you say?
Not in China.
Yeah,
not in China. It take a long time to do that in the US. Look at Biden's big blue wave infrastructure plan. How's that getting along?
What's interesting, Ryan and Kman, I'd love to, we can have just a really short conversation about this. I was I listen to a lot of podcasters and analysts, and there's this Chinese analyst. He does the China Beige Book. The guy that runs China Beige Book, I think they are on Twitter actually, and he digs through a lot of the Chinese data, and he made a really, really interesting comment about Xi Jinping and about how he is really he's come to the realization, like longer term, that for China to do stimulus like that is not going to it's not going to get them. They've tried it. It's not going to get them very far. And he's been shying away from doing a lot of infrastructure spending and being more of a holistic type of economy to try to gain traction for the rest of the world. He's coming to the realization that doing all this infrastructure spending and just building a building, tearing it down because it's sat there unoccupied for 10 years and rebuilding it, it's not doing anything for the actual economy, longer term. And exactly. So I found that rather interesting that he felt, and then this is, somebody that does a lot of, analysis on China specifically, because I don't, but he does in his company, that this is the trend that he feels that China is now following. They're not going to be going down that road anymore that they have been for the last decade, which I don't know. I think is fascinating, but that leaves them vulnerable near term to, lack of stimulus, if you will. So I don't know.
It doesn't fix the underlying problems, of consumer spending, of exports. They're facing this decoupling, where everyone wants to move away from China. Well, they're such a huge exporter, they can't make it up domestically while they don't allow their people, the same sort of freedoms that we get. So it's the old rock and hard place for those guys over there. But they can manufacture up their own data and their own economic activity, even if it's not real. And they just turn around and say, we hit our growth target, 5-6% or whatever. How great are we?
Yeah. Kman, do you have any comments on that? It's being somebody that spent a lot of time in Asia. I know China and Japan are two completely different countries. I was actually born in Taiwan, so I kind of get that concept. But do you have any topics, any comments regarding that?
Yeah, I think Xi has understood that him only supporting Russia is not going to resolve a lot of problems. So he's trying now to play on every single board he can. He knows he can't do without Europe. He knows he can't do without the US completely. So he has to play on every board. So they have to do stuff internally, but at the same time, we also hear a lot about trying to open their markets in such a way to re-attract foreign investors, which is going to be basically I know there's so many Chinese that you have to take into account the Chinese consumer, but the Chinese consumer will only consume if China can export, because that's the only thing they can really rely on. Because if you have your massive amount of people there, so you need your developers, and they are going to create problems or solve problems. But in order for your consumer to consume or buying houses, you need to export. So and I guess that Xi has understood that. So it's not the massive stimulus that that we may expect, but at the same time, he's trying to play multiple chess pieces at the same time. That is what I'm thinking about it. And you know what, the investor hasn't really bought it yet, because we are pretty stable, and the only reason why we are very stable in dollar China is because the PBOC manipulates dollar CNH, right, and dollar CNY fixings. So that on China. The other thing, if I may just come back to your bond discussion from before, that's why I was highlighting those treasury issuances, because this week, and I've spoken about that in the flow show, and I also highlighted it yesterday in our chat rooms for those who want to go back and have a look at it. I think there may psychologically be a change in the bond issuances when the treasury does it, because if the market judges, so we had these people buying bonds when the US was back on track to get and the exceptionalism, the people would still buy US bonds even when yields would go higher, because they wanted to be invested in the US, right? But I reckon, and there you have to be very careful who is buying those bonds now, because if a lot is done locally, that may mean that the US big investors think that the yields are getting high enough to pile back into bonds. So keep a very close eye on how those treasury issuances will go this week, because I think it may be pretty important even for the dollar, you know, and sending the yields up or down for that matter.
Hey, thank you very much, Kman. I know we just have a couple minutes, and Dale, you have somebody that you're bringing in. I appreciate your comments, Kman. We need to bring in Grega. We had a real quick question about the dollar Mexican peso. I just want to point out that it's holding up very well, right at 1850, which is, you know, big previous channel resistance. It's also that previous support. And if the dollar Mex breaks out, I would be really cautious if this thing breaks above 1850. Because if we break 1850, I know I made a big stink about it on the week ahead video, but we stopped there yesterday. We stopped there. I mean, we're holding barely, and you got to watch it. If we get above it, and I could really start to squeeze. Also, Grega, before I turn it over to you really quick, or just ask you what you're seeing here. I also have to say, with the dollar Canadian, we talked about this inverted head and shoulder pattern yesterday. It completed. We've reversed. I have to say that the Canadian and the Norwegian krona have actually held up really well. You can see how strong that they were yesterday in light of the crude oil rally, or the snapback that we've seen over the last couple of days. And let me just say this: if crude oil starts to get above $88, I don't know if you want to be short crude. And also, it's going to have an impact on the Canadian.
Not yet.
Norway.
Not till after there's military action against Iran.
Yeah. I think that's what everybody's watching for, right? Did Iran have did they have a hand?
Well, it was really China. China sabotages deal. Iran's a proxy state, and they just cut a deal between the Saudis and Iran. If you recall, a few months ago, they and the U.S., Israel, and Saudis were on the verge of a peace deal, or at least a deal of more understanding. That's dead now. So China has a bunch of proxies, including Russia and Iran. So China's running the show for that access, and I think they were behind this, gave Hamas the go signal, Iran to tell Hamas, go. And, you know, one more thing, you think about this, Israel, gold standard in security, Blake, and, you know, still a border was exposed. It made me think about our border and how porous it's been over the last several years. They're not all illegals coming across. There could be bad actors just floating in. You know, since 2001, for 10 years, we worried about terrorism. And we have forgotten about that.
We've become very lax.
We're too busy hating each other to worry about anything happening on the outside. And True. I think that there's that was a go signal for operations everywhere. So just something I wanted to share that
thank you,
can't make
Dale.
money off of. You can't
Real
make
quick,
money.
Grego, I know, sorry, we've led really into all this time, but I was looking at your euro count here on ForexAnalytix, and you're looking that the euro is going higher and it's going to eventually break higher. Do you still feel that way after today's rejection?
Yeah, I mean, I still think that the dollar by the end of the year could face some major reversals, but picking a top for the US dollar right now, right here, could be a little bit too early. But what I really like is gold on the upside. I mean, even if stocks will continue to sell off on these geopolitical tensions, I think that gold will be attractive as a safe haven. But even if stocks will stay in uptrend, dollar will see more weakness. So still, gold will most likely stay above the support. So I think that gold still has a very nice upside potential. If you switch to the 4-hour time frame, to the 4-hour chart, Blake. Yeah, exactly. So you can see that there is a gap from Sunday. Maybe that could be a very interesting intraday support. And then we see more gains. So 1830 around there, I think that's a perfect spot for a new bounce here.
So yeah, if the dollar gains a little bit gains a little bit today, maybe it pulls the dollar back, back towards that 1830 level, and then you can look for potential longs down there.
It's a pretty nice intraday impulsive reaction higher from that support that we've been watching February, March lows. So I think that as long as we are above that level, there is good chance that we will actually continue higher, in my opinion.
Is there any count that would take it down to one more low before this scenario unfolds?
Yeah, I mean, it could, but I still think that we firstly have to see ABC rise away from that lows. So 1880 will be the key resistance. Okay. So if we fail there after ABC rise, we could potentially continue back to the lows. But for now, I just think that in the intraday basis, we should stay on the bullish side. But if someone, let's say that dollar will continue strengthened, I really like cable. I think it's at very strong key resistance there. So just be aware of potential maybe turnaround Tuesday. Also, this could obviously unfold as well if stocks would continue to.
It's funny. I have this drawing tool, this Zoom drawing tool that it's actually work in my way. I'm trying to move it out. You guys can't see it, but I'm trying to move it because I can't see past it. But now I can. So here we go. All right. So we have the cable. Here's a 4-hour chart.
Yeah, and you are exactly now at the potential resistance 12280. We are at that area. So I think that's still in downtrend. We cannot not deny that. And there was the March, I think it was March lows at 1.18. So a lot of markets has reversed towards this March swing lows. Okay, so I think that looks like that. This could be retested if dollar is getting stronger still.
Awesome. And Greg is also, he popped in our chat room today, and it's good to see you in there, Greg. And thanks for your update on the ForexAnalytix platform. He is our in-house Elliott Wave analyst. So, to get his analysis, obviously I would be following Greg on Twitter, but he also contributes to the ForexAnalytix platform. So thank you so much, Greg. Dale, I know you have an interview here. And I don't want to bleed any more into their time, but I want to thank you all for being here today. And Dale, I'm going to pass it over to you. Thanks, Kman. Thanks, Ryan. And you guys, if you're not listening to Kman and Ryan in the European hours during the Flow Show, if you're up trading during European hours, you should be listening to that show every day. So they help prepare you for the markets for free. So there you go.
Cheers, guys.
Thank you, Dream Team.
Thanks, guys.
Thank you.
George Robertson, pleasure to meet you. Welcome to F.A.C.E.
Yeah, do you hear me there?
I got you, George. How are you?
Pretty good. Good. I'm complimented you had me on.
Thanks for granting it, George. I saw you on Twitter, and looks like interest rates and bonds are your bailiwick. And, before we get going, I always like to find out a little bit about people's journey, how they get from point A to point B. So, I went to your Twitter stream and it said that you started at Sally. Was that Sally Mae or Solomon?
Solomon Brothers.
All right. Okay. Great big bond house. So that was your first job in the industry. Were you thinking before that you wanted to be involved in the financial markets?
I got to confess, it wasn't my first job in finance. I was a stockbroker in Toronto with my Harris tweed jacket and my gray slacks.
Yeah.
And I had a few dentists as my clients.
All right,
I did such
prospects.
terrible stuff to them that I was scared that I'd never get my teeth fixed ever again in Toronto. So I picked up whatever I had and came down.
Did you have to leave Canada? You're down in the States now?
I had to leave Canada, and it's for me, it is not safe yet. So that's
okay.
I won't go too far.
Can you explain your handle at Bicker and Brattle?
Yeah, Bicker and Brattle. That's I apologize for that. Sorry about that.
Okay.
I apologize for that. That's from Robert Burns. It's about the mouse where he's plowing his field and he finds a mouse nest that he ripped apart. And it's just it's a poem about the inexplicable tragedy, chaos that can happen when you think everything's nice and cozy and you're in your little mouse hole. And there you go. So that's Bicker and Brattle.
Okay. All right. Thank you, George. So, I did go to your stream and it's time to talk a little bit, talk some markets with you. So let me just share. So, this has been one of the worst bear markets in my career. And I don't know if it is in history, but in my career, I mean, TLT from 170 to mid 80s in a couple of years. I'm starting to see some technical signs that we could be setting up for at least some type of bear market rally. Doesn't sound like, or what I see, that you talk a lot about directional stuff in interest rates. But do you have a view? Because go ahead.
Yeah, I do. And it was really interesting. I sort of eavesdropped on you guys about a couple, 10, 20 minutes before this forum. And it was a lot of discussion about things that usually I haven't had too much involvement. A lot of technical analysis, a lot of, double tops, triple whammies. Now, 20 years ago, I would have been somewhat dismissive, but now I'm not at all. In fact, Matt, I think that's where it is right now because people are overthinking the macro. There's really massive flows going down, but they're only happening about every 6 months to 18 months. There is not this constant meme that's going around about, if Powell will do this, if employment does that, and so on. It is not a responsive market now to macro. There's just 2 or 3 things. So what really counts now is just to be a superior risk manager. And that's where the respect I have for the approach that I heard was that if you, you might catch some things, maybe you get 55% average that you actually called the market. But one thing you don't get caught up in when you approach the market with the detail of the levels that you guys look at is you don't get cut off and you don't get cut off at the knees and destroyed. You're always very close to
know where you're wrong before you pull the trigger, and
right.
then and have your stop there.
Yeah. And so I think what is really interesting is that I don't know if I'd call it a bear market or a bull market. What I do think is that we have a fascinating situation where the last 30 years of certainty of what the Fed was doing, that the market was very confident. They knew the Fed, that they knew Treasury supply, demand. They knew all these variables cold so that it was just plug and play as we got into an era where none of those variables really count anymore. We're waiting for the big event. We've got the stage set. We got everything going, and I'm not talking about doom and gloom and the U.S. is going to blow up or go bankrupt or anything, but I am talking about a very significant regime change where we're no longer under like the autopilot of the Fed taking care of us. Sometimes you're wrong, sometimes you're right, but you can count on the Fed. The Fed's not there. And I say that not as a debater like an anti-Fed guy, but I say that just because I don't see any signs of the Fed in terms of the macro economic analysis, the monetary economic analysis that I do and have done for decades. So that means that to be very, very conscious of price levels and innate understanding of volatility and risk is probably the way to go as we wait to see where this goes, where it plays out.
George, any comparison to the 70s?
Yes.
So I mean, there are a lot of things that have parallels with the 70s, and wondering if, we're not in that type of, we went through that type of regime. And also what's interesting is, what they brought back, the old term I hadn't heard for a few decades, bond vigilantes.
Yes,
the bond vigilantes are back, and we hadn't heard about them for, a couple decades. So,
right. What was it? Carvel said if he died, he wants to come back as a bond, right? Scare the hell out of everybody.
Yeah.
It's in my approach, I don't really see anything bullish or bearish in yield. I see treasury yield as being reflective of the very long-term potential in NGDP growth. And NGDP growth, of course, contains real growth and it contains inflation. So where the 5 years going right now is, I think there's two things going on. First, it's quite normal that if this NGDP growth is going to stick with us for a while, that the 5 years should be here. Actually, I think it's going to go higher. And then the second thing going on is that the Fed went on for a very aggressive experiment that I don't think was really discussed much, which was from 2012 on. QE, they sold it as like an ease. Well, it's not an ease at all. What it is a very large, significant redo of how the banks are managed and overseen by the Fed, in particular the reserves. That being the case, the QE was actually not an ease. What it was a moving from not just controlling Fed funds, but basically taking over the whole curve. So we had a bit of this from Fannie Mae back in the Reigns time and in the end of the 90s. But it was just a bubble. And we had some of it in the 80s when World Bank couldn't do anything more than the 5 year. But we have an extraordinary move by the Fed that it dictates not just Fed funds, but 2 years, 5 years, 7 years, 10 years. And then duration starts to be a bit of a problem. So it doesn't quite.
Didn't the Fed tell all the banks to load up on long duration a few years ago when rates were at 130-year lows?
Yeah, I don't think they dictate things like that. But
how did it happen then that they all got loaded up?
Because if you have a couple $1 trillion coming sort of force fed into the banks, like here's the money that we're going to give you because we're actually holding it. And it was the Fed that more or less maxed out on the 10 years and the 5 years. And so I don't think, as far as I can understand by looking at the bank balance sheets, I don't think they're really in that challenged position right now. I'm sorry, I'm in Europe right now. I'm visiting my son.
Where are you?
Well, it's I'm in Garmisch, Germany. Okay. The NATO army base.
Okay.
As the Fed built these reserves up, they just sort of stuffed it into the banks, and then they dropped the curve. It used to be I forget what that rule is, 3, 3, and 10 or something like that, where you would just show up at 10 o'clock in the morning and you do this and that, and you would just ride the curve, and the Fed would hold things steady, and everything was in good shape. Well, the Fed just took that away from the banks, and it just said, here's another 3 trillion, 5 trillion in terms amongst all of you, and go put it to work, or at least give it back to us, which is what they did. And there wasn't any yield. There was no curve. The Fed destroyed the curve. So I think that led up to what you're talking about, is that they started to incrementally add duration risk so as to get some sort of cash flow or earnings. But the banks are the system's pretty sound. And these reserves are very, very large now versus what they were about 10 years ago. So I don't think that's a problem. I think what the problem is the Fed's aggressive and even hubris that they can command every risk-free rate there is from Fed funds right out to 10 years.
Okay, and what are the risks of them doing that? People say something breaking, the rollover of debt that corporations are going to have to go through, and everyone say next year that it's going to be sticker shock where they were financing and where they're going to have to roll over to.
Well, I'm probably going to
surprise me
there. I'm probably, I'm just going to disappoint you, is that U.S. treasuries are perfectly fungible. Like, in other words, I give you $1 trillion, you can give me $1 trillion. And if I drop it to 500 billion, you drop it to 500 billion. They're an asset liability problem always, as far as the macro and monetary economics go. So there is no demand supply problem for the system. It just doesn't exist. And that's what I said.
Just lost you. Are you still here? George? He's gone. All right, well, that's showbiz. We'll get George back, everybody. I had some questions to ask. Anyway, thanks for being here on Turnaround Tuesday, everyone. Good hunting the rest of the day. We'll see you tomorrow, and I'll reschedule George. Guy had some interesting things that I wanted to talk about, but we have to adjust. So don't just count your pips, count your blessings, everyone. And we'll see you tomorrow. Could join the team. A little less than half an hour for the morning edge. And it's good to have internet back. Great to be back with everyone. See everyone tomorrow. You're welcome, Mary. All right, guys. Adios. Hold on. He's back. George is back.
Hi.
Hey, George. Okay, you're back. All right. So
I apologize. I left my phone. Anyway, that's my excuse is I left my phone and stuff, so I had to buy one of these Apple things, and I hate Apple.
Okay.
And sorry about that. Well, what I'm saying is the treasuries are an asset liability problem always for the government, for the Fed, for the banks, for pretty well everybody. And in fact, they're identities. That means if you do something like this or that, then you will have you'll have a corresponding balancing out of it. And so it's not a problem. This is a hard concept for people to come to terms with. They're always trying to say, well, if there's only 500 billion of issuance at this 1 month, and now there's $1 trillion, it must be that there's a supply demand problem. And that's just not the case, or at least it's never been the case in my experience.
That's what everyone's talking about. The supply that the government is crowding out everybody, and you're saying that's not true.
No, it's. I think there could be small effects on like the 5-year, the 10-year, the repo markets, and we have seen in the repo markets. But as far as like setting the 10-year rate, the market rate, how it trades right now, I think that's completely a function of the Fed still administrating rates and letting it go as they do QT, as they start to let some of the treasuries go, in which case the treasury is going to move to where the real rate is right now in terms of where 10-year U.S. risk-free, not just necessarily the U.S. Treasury 10-year, is pricing the risk of the NGDP and inflation and, what Marjorie Greene's going to do and what the Fed may or may not do. It's not an issue of supply.
Okay, so do you think the 10-year could trade up towards 6%?
Yeah, I'm pretty. I have I have a lot of comfort in that call, more so than I've been in the last couple decades, and it is completely a macroeconomic, monetary economic call. The problem with this call is that it doesn't have a mem. It doesn't have anything for anyone to do month to month, week to week. And likely it's going to take place, as we've seen it in the last couple of weeks, with very significant jumps up and then just sort of faded and people trade. And then you get a very technical approach to it.
So we have kind of like it's getting parabolic is what you're saying.
I think it's, I would use some of my option experience. I would call it a jump to fusion. But that means that the volatility is maintained, but then you get a whacking, up 10%. Or down 10%, and then you digest that, and then you go back to the regime of vol that you have in the market.
Okay. So with that forecast, George, you're sanguine about equities, and I believe you said that, there should be no reason why we can't see 5,000 S&Ps, and and that's including what you're thinking on yields. Where the market has been so resilient in the face of higher yields, in the face of a stronger dollar. So you're sanguine. Does that mean that earnings are going to keep coming through? No, even though yields are headed higher?
I think I think earnings, well, that's another rabbit hole I can dive into. Ever since the S&P 500's leaders have been so concentrated in only 4 or 5 key people per company.
The Magnificent Seven.
Yeah, they're really not too worried about earnings. They're worried about I don't know, the politics, the power, their legacy, where they're going to go for the next 10 years. They want to get rocket ships launched and important things. And it's not like it was even 10 years ago, where quarter to quarter earnings really counted. And then the second thing, we have all these massive offshore tax schemes, basically scofflaw schemes to avoid paying taxes in the U.S., which, even though Theo/Trump dropped corporate tax down to 12% or so, it's still not equivalent to the Irish tax rate of, I don't know what it is, 7%, 8% now. So that gives them a huge room to put their IP and various other licensing rights in Ireland, do all the industrial wherever, making the stuff in China or how have it, and their marketplace in the U.S. and avoid paying taxes. Now, what this ends up with is that they're very, very forceful in terms of managing their earnings. If you look at the NIPA, this is the Bureau of Economic Analysis counts of all the corporate profits in the United States. You'll see very quickly that.
Do you have that up here, George? On your hub page?
In the, where do I have that? That's my whiz bang set. That with the verbiages. But anyway, the U.S. The Bureau of Economic Analysis says that corporate profits for the nation are at record highs. Just there it is, right there on that side. And this graph you're having right here is the national accounting of corporate profits for the nation. It is sort of plateaued there for a bit, but it is at very strong right now, and it's not showing up in S&P earnings. So I think what all this adds up to is that the S&P earnings are not quite as much as the drivers they were like 10 years ago. And again, I'm speaking in terms of macro flows that are taking 3 to 8 quarters to play out right now, which are probably beyond the career objectives of anybody that's trying to make a living week to week in the marketplace. So it is, yes, I'm right. But then who cares? What we have to do is figure out what to do week to week, day to day. And I think that's
trade. Do you trade, George, at all? Do you trade?
I used to trade a shitload, but back in the day, I still trade from my personal account.
Yeah.
And I've found that the trading I used to do, which was more akin to like, making flour out of grain. And what you try to do with your personal account, even if it's of some substance, that is 15 times harder than it is to trade for a large institution.
Yeah. Okay. All right. And anything actionable that you see? Are we at any kind of inflection point? I mean, my original question was, say, for example, TLT got down to 84. I'm starting to see some technical divergences here for the first time. In fact, big picture on TLT, let me just go to it. So we took care of some unfinished business a week or so ago, and that was clearing out the October low. Okay.
Yeah.
So the October low. So
I would be a little careful with that. I would stress that when you feel that the trade is to short TLT, because I don't think we've seen the end of these rates rises.
Okay.
Then,
so sell a rally.
Be a little more comfortable with that trade. And then if you do go the other way, which I obviously caught a couple of these waves that have worked out quite well, just be more than usually cautious in terms of how long you stick.
Okay. Anything on the equity side? You have conviction about the S&P's trading towards 5K?
Yeah, I'm fairly comfortable on that. Is it December? Is it next quarter? I'm not certain, but I do know that the major, if you look at like not just like the analysis that you're applying in front of me right now, if you just look at like what is the core, the central theory for all bears right now, and it is that the Fed has induced a monetary cycle and it is tightening. And, we might get some more Fed funds up or maybe nothing, but that is more than enough for anybody with any sense to look forward to a lowered NGDP, higher unemployment, and therefore a bear market. The problem with that is that it doesn't show up in any of the macro flows. There basically is no Fed in terms of being able to affect that type of change in NGDP. And if the S&P 500 were to trade aligned with the NGDP that we've seen, since April 2020, it should be well over 5,000.
Okay. Do you have any kind of business? You're just doing this to, educate people and share your views?
I'm sort of casting around what to do with a lot of time on my hands right now. My risk manager, my partner at home, says that I'm retired, but I'm not too keen to do it. My habit was 12-hour days, so I'm still at it.
Okay. Yeah. Have you ever been to a retirement dinner for a financial trader?
Usually I don't make it that long.
Yeah, there you go. My retirement plan is slumping over my keyboard.
Right.
So, anyway, George, really a pleasure meeting you. I'd love to talk to you again, and as things move forward towards the end of the year, and see if your
sure.
views
And
have
I'm
changed.
I can take it. So if I'm sitting there going biddy, and the S&P's at like 3,000, have at me.
All right, I'll be gentle. All right, buddy.
Okay.
All right, and you survived
sure.
an interview with Dale Pinkert, makes you my trading warrior brother now.
All
so
right,
everyone, George Robertson, if your interest is bonds and yields, he really has from what I've seen, and I do a lot of intelligence gathering, really interesting and different types of ways of looking at what's happening in interest rates that a lot of people in a conventional sense do not. So check him out at Bicker and Brattle, George Robertson, and check his charts out on his R Pubs evaluating. He's got some real interesting charts there. So thanks again, George. Appreciate it, buddy.
Thanks. Great compliment. Thank you.
Hey, have a great trip and a great visit with your son, and safe journey home.
Okay. Thank you.
All right, that's a wrap, everyone. Remember, don't just count your pips, count your blessings. See everyone tomorrow. You join the team in 15 minutes on the Morning Edge. Adios. You're welcome, Jamie, Mark, all you guys. People are thanking you, George.